Hello friends, welcome and thank you for watching this short video on Union Mutual Fund's market outlook. In the next few minutes, I will take you through our views on the overall market. Before I talk about the market outlook, I would like to talk about what moves market prices. We are all aware of the simple equation: market price is equals to earnings per share multiplied by PE multiple. The job of a sell side analyst is to precisely estimate the earnings per share. However, the job of a buy side analyst or a buy side fund manager is to judge what PE multiple he should pay for that earnings. PE multiple in turn depends on four factors: return on equity, earnings growth, risk-free rate, and riskiness of underlying asset. We will now discuss the market outlook in context of these four factors. According to the IMF, the world economy is expected to stagnate at about 3.7% growth. However, Indian economy is expected to accelerate to 8.2% growth by the year 2023. This would make Indian economy one of the fastest growing economies in the world. As per IMF, in the last 8 years, Indian economy has grown at a pace far higher than even the faster growing emerging market peers like Brazil, Russia, China, Indonesia, Turkey. Remember that in those 8 years, Indian economy has endured quite a many shocks. For example, in fiscal year 2017, we endured the demonetization shock. In fiscal year 2018, we had seen implementation of GST. Despite all of that, India has remained a high growth economy. Investment demand has remained subdued over the last many years. This has been due to weaker capacity utilization, which has now started to ramp up. In fact, as per the latest figures, capacity utilization has already reached 75.2%, which is a multi-year high. However, we need to be aware of some of the near-term macro challenges in the form of trade imbalances as well as weak monsoons. Risk-free rate is a very silent but oft a very important driver of market valuations. Quoting Warren Buffett, interest rates act like gravitational pull on asset prices. Higher the interest rates, lower the valuations, and vice versa. Globally, we are experiencing a rise in the overall risk-free rates. For example, in the US, 10-year bond rates have already increased from 2.1% a year back to about 3% currently. Even in India, we are seeing the 10-year bond rate already increasing from 6.5% a year back to about 7.8% currently. Additionally, developed world central banks are taking steps to reduce the quantitative easing measures they had implemented about 10 years back at the time of global economic crisis. This gradual unwinding of quantitative easing is likely to result in reduced liquidity globally and is likely to result in increasing stress on risk assets. Back home in India, RBI hiked its interest rates by 25 basis points, citing building up of inflationary pressures. Recently, we had seen Turkey being engulfed in an economic crisis. The Turkish lira fell by about 53% on a year-to-date basis, and the Turkish bond yield had climbed by 2x from 10% to 20% in the same period. Global investors panicked, and that resulted in a material underperformance of emerging markets in the recent times. Having said that, while India is vulnerable due to its high current account deficit, however, it is far away from a crisis, as we have very low debt coming in from foreign countries and we have a very comfortable foreign exchange reserve. The Q1 fiscal year 19 profit after tax for Nifty companies increased by about 10%, significantly lower than market expectations of 20%, predominantly because of losses posted by some of the banks. These losses were primarily due to bad loans being written off and due to mark-to-market losses on bond portfolio of these banks. Excluding banks, the overall market earnings were almost in line with market expectations. For the next 2 years, the market expects earnings to grow at 20% and 24% respectively. Nifty trades currently at about 23 times trailing 12-month earnings, which is one standard deviation above long period averages. The mid and small cap companies trade at even higher premium valuations compared to their longer period averages. Based on our proprietary fair value framework, Nifty trades at a significant premium to its current fair values. Summing up, we expect that the current unwinding of quantitative easing measures by developed world central banks like US Federal Reserve, the ECB and the Bank of Japan in the next 2 to 3 years would result in a significant reduction in liquidity, especially for emerging markets. We need to be cognizant of lurking global risks in the form of heightened trade wars, increase in crude oil prices and the resultant impact on downstream products and its ultimate impact on inflation. However, the Indian economy is recovering smartly after experiencing the twin shocks of demonetization and GST in the last 2 years. The economy is expected to witness a cyclical uptrend driven by improvement in investment demand over the next few years. We are overweight IT and healthcare sectors and we are underweight financials and materials sectors. In the current market scenario, we prefer large caps over mid and small cap companies for valuation reasons. We expect a low double digit improvement in Nifty fair values over the next 5 years. We advise investors to invest in asset allocation products to take advantage of valuation changes as well as to reduce risk. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.